And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. More wild trading and an extraordinary morning here, including in ETFs. The market gyrations have been head-spinning with big drops interspersed with big rallies. Just take a look at the last 5 trading days. Last Monday, down 7.6%, then an up Tuesday, but a down Wednesday, and then another big down Thursday, then a rally Friday, up 9.5%. Today, we're down again, and a third trading halt, the third one in the last 6 trading sessions. So let's try to make sense of all of this with Tom Lydon of ETF Trends, Andrew McOrmond of WallachBeth, who joins us by the phone. And Tom, we talked last Monday about how the ETF structure was holding up well under enormous stress. Is that still the case? What's your assessment right now?
Well, Bob, I think it is. I mean, it's getting high marks. Notional value traded 45% on the exchange. Crazy. $200 billion on average. And when you look at the ETF structure, it really is holding up well. I mean, all the things we heard during the flash crash, the concerns about liquidity, I mean, there are little instances here and there. But in general, the amount of volume that's going through ETFs is absolutely incredible. They're getting tested in a big way, and I think they're getting high marks.
Yeah, I think that's true. There's a little bit of concern in some areas. One thing's for sure, Tom, flows. This is the money going in and out have been simply titanic. Let me show you some figures here. Last week, there were record flows in bond funds across the board. So we saw, for example, record inflows into money market and government bonds. And we saw record outflows from investment grade, and the second highest outflows coming from high yield. Now, Andrew, our fellow ETF buddy Chris Hempstead noted that LQD, that is the investment grade bond ETF from iShares, closed 4.5% below its fair value on Thursday, and the average premium is usually pretty tight. It's only about 6 basis points. Now, Andrew, I wonder what this tells us. Does it imply that the last prices of the underlying bonds aren't really reflecting the prices the bond market participants are willing to pay? What does this tell us? Walk us through this.
Point of what's happening. The stale pricing is the right word of the actual bonds. It doesn't reflect the depth of liquidity at that bond level. As we've always taught, and we've said many times on ETF Edge, an ETF's liquidity is really a function of the underlying liquidity of the asset class. And although there was bids seen on the market, in the bond markets, in the corporates, they weren't simply able to be actionable or able to have depth. So market makers were not able to accurately hedge. However, you were able to get risk. It's just a function of how much risk premium you're willing to pay.
Yeah.
A mutual fund you cannot get in and out of during the day, and these ETFs held up by giving people the right to sell if they wanted to. People that sold earlier in the day in those bonds, in those bond funds, just happened to time it correctly and get out before the discount evaporated.
So the point seems to be, Andrew, that it's who gets it right here? Did the ETFs price it right, or were the bonds a little bit behind what actually the public was willing to pay? I'm not trying to assign any blame or anything.
Right. There's no blame.
Are the ETFs pricing the market right, or are they getting it wrong?
Right. You're getting it right, but we're at max levels of uncertainty. And you have to give market makers a little credit for still willing to stand in there under these unprecedented times and make a market. They are just simply pricing in the premium to transfer the risk from one client onto their books. When uncertainty reaches its peak, which I believe we are getting closer to, and I don't mean the peak of a coronavirus and its effects, just we have some clarity economically on what it means for interest rates, some clarity on what it means for these companies, then market makers can more actively and calmly price markets.
Right.
Yeah,
and Tom,
Bob,
maybe a little bit
Tom,
of an
if I can
ETF.
jump in. Yeah, a couple quick things. Number one, 90% of ETF trades are natural trades from a buyer and a seller. The whole thing about 10% being creation redemption is really key and critical during these times. And as Andy was pointing out, the arbitrage instance here that keeps that spread really tight is important. But if the APs are buying these ETFs at a discount and going to market and don't think that they can make up that underlying, that's where the disconnect comes in. So it really comes down to the underlying pricing of the bonds. And with these mutual funds, they use pricing services that may be completely out of whack. It really comes down to what people will pay.
Yeah.
And in this
so this
case,
goes back
ETF
to
pricing is right.
The wisdom of crowds, Tom. We keep talking about this. Are the ETF people pricing this more accurately than everybody else is? I mean, we saw this with in the past. Several times, S&P futures were locked limit down of 5% prior to the open, including today. Yet the underlying ETFs, particularly SPY, traded just fine, and they accurately predicted the S&P would drop about 10% today, and it opened, and it did. It was
right.
We saw this with China stocks when China's market was closed in early February. They accurately predicted where China would open. So I'm just asking, Tom, with these discounts to the net asset value, is this the wisdom of crowd, the law of large numbers? The underlying securities don't trade, but the participants seem to get the direction right.
Well, everyone's paying attention, everyone's communicating, and I think what you point out, Bob, in these volatile times, people look for anomalies where they can swoop in and take advantage. With so many people paying close attention, probably like you yesterday, we didn't miss sports because we're paying attention to the White House, coronavirus, and the Fed and all that. It is down to what people will pay, and there's not a better vehicle out there than ETFs to replicate
and the alternate side of that, Tom, as you know, is if, again, we think it's a great thing that these pros are willing to step in and make markets. We engage with them every day. If there was an opportunity for a free or, really, really great arbitrage to make quick money, then the spreads would have collapsed. They're all paying attention to that and looking for opportunities. And doing the best they can to price things fairly and stay open as a business. If there was really easy arbitrage, it would happen, and you'll see that as vol starts to dampen how much tighter spreads will get.
Yeah,
Let me talk a little bit about what you can advise investors for. We're talking about the ETF business itself. Andrew, the advice to long-term investors from people on our air is basically sit tight. This too is going to pass. Now, for those who are more actively trading, what kind of products are you advising active traders to use to address this volatility? What kind of ETF products might work for you?
3 really quick points on that. I mean, obviously, we do know very active, traders that don't use options. I think options are a great thing. I would focus on listed options, listed index options and ETF options, but understand that vol is high and understand the pricing, meaning that you're going to pay up to put your idea on, and certainly there's risk in selling those ideas. For ETFs themselves as listed tickers, you could look at liquid alts like QAI and MNA, which are less correlated to the overall market and can dampen volatility. And for the traders that have to trade, the last point I would make is RIAs and large strategists, do everything you can to institutionalize your order flow in times like these, meaning have all your options on the table, use professionals. Don't let multi-million dollar notional orders go into retail pipes to be executed. It's time to institutionalize that flow. I think that would help a lot.
Yeah, and Bob,
Tom,
just to add on top of that, at the end of the month, we're just 2 weeks away from monthly and quarterly rebalancing. So these indexes are going to have to go in and buy more of what went down the most and sell what went up the most. That's good. 82% of advisors use model portfolios, and 60% of them actually have tactical strategies. So at the end of the month, it's going to be very, very interesting to see how all this rebalancing kind of works itself out.
Yeah, Andrew, if you had to do a postmortem, let's go down the road 3 months from now. I don't know where any bottom is, but if you had to do a postmortem on this, particularly for the ETF business, and it seems to have held up reasonably well, other than a few anomalies you were talking about, would you have anything on your list? Would you say, you know what, we ought to do next time, we ought to do this, or some advice that you would have for people if you were running the entire ETF industry?
Well, I think the main thing I would say is I love the way that they've held up. I love the way that you could trade them when futures were not able to be traded. I think we can explore the short tick rule. That also actually was able to make spreads a little wider. I understand why that's there, so stocks aren't driven down. But I think in general, like I said before, the best thing that investors can do is learn all their options of execution, learn all the routes that they can use versus, trading on the open and close. We need to continue to educate people, because usually the bad trades are just kind of mistakes that occur in order flow entry, and that can certainly be rectified by more education.
Tom, any advice any postmortems you would like to do here at this point? Anything you've seen that you'd like to improve?
Well, I think the ETF industry operates in a fishbowl, and Bob, you've been on this for years and years and years. We're always looking for that chink in the armor, and we haven't found it yet. We've got people like Andy who are on the front lines doing hand-to-hand combat every day, and they can be our mouthpiece if something's going on. So most importantly, I think we're cheering on the ETF business for sure. It's doing what it's supposed to do at this point. Going forward, I think his words of wisdom about being calm, sticking to your long-term model is important. If you're trading, make sure you're efficient in your trading.
I think the most important thing that I see here is that, once again, ETFs are directionally correct. We don't even use S&P futures as much anymore in the pre-open. We use SPY because there are days, we've had several days in the last week, where the futures, the S&P futures, are lock limit down at 5%, but the SPY and other ETFs continue to trade and give very accurate indications of where the market will go. This is really rather remarkable to me. Again, Tom, as you know, we've talked about this. We saw this with the China stocks when they were closed in early February. To me, this is a vindication that the wisdom of the crowds, and I call it a slight miracle that they get it right, because so many people are essentially making bets, kind of get it directionally correct, even when liquidity is tough to access, as we saw with some of these bond ETFs, Tom.
Yeah, and also, Bob, isn't it funny how we talked about this race to the bottom in fees, and through this whole thing, we're not talking about expense ratios, whether you're paying 4 basis points, 9 basis points, or 50 basis points. What's most important is trading efficiency and keeping an eye on that. And that's really key and critical during these times. And I think advisors, institutions understand that. Great lessons for advisors, too.
Yeah, I predict that this will really throw a lot more money from mutual funds into ETFs for frustrated investors that had to wait to the end of the day to get marked to a NAV. Again, that works for several. There's a large bucket of investors that works for, but there are investors that need liquidity, and certainly ETFs provide that.
Yeah, and there are trillions of dollars in mutual funds today that aren't getting priced accurately on the fixed income side, Andy, and you're absolutely right. So this will be under the microscope for sure, and we'll be talking about this in the months to come.
Yeah, and we want to remind everyone, of course, that is the essential difference between ETFs and mutual funds. ETFs trade throughout the day. Mutual funds do not. You want to buy or sell your ETF, you get the closing price. And of course, that's the big issue. We're in the middle of an extraordinary day again. We are down about 8% in the S&P 500. We were down as much as 11%. 2409 was low on the S&P. We're at roughly 2492 right now. Keep an eye on all of that. And what an extraordinary day, an extraordinary week we are in the middle of. And all of us here at CNBC, of course, committed to covering all of the action for you. And that does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Tom and Andrew for joining us today, and thank you for watching on this extraordinary events. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.